This chapter 2 describes and analyzes the reasons issuers issue and investors purchase convertible instruments and the risks and benefits for each party. We take the perspective of the investor first. Rather like a principal-protected equity-linked note, a convertible is attractive for investors who are bullish on a company's stock but are unwilling to take full risk to their principal and purchase shares outright. An IRR comparison can best illustrate the pros and cons of these two alternatives, so we turn next to worksheet IRR. Column F in this worksheet once again contains a price range for the stock starting at 20 and going all the way down in the part of the worksheet that you cannot see initially to 90. But careful, this time these are the prices of the stock on the bond's maturity date in 5 years. Final stock price, it says here. Now, if we accept one small inaccuracy, we are ready to derive for either investment, the stock or the convertible, the IRR, as solely a function of the initial amount of the investment, $100, the 5-year tenor of the investment, or holding period, if you like, and the periodic cash flows you receive, whether of coupons, dividends, and of course the final payoff at maturity or final value of the shares, if you get shares at maturity. The one inaccuracy we just mentioned, but which we need to accept, is to assume that the dividends remain constant in absolute dollar terms per share, rather than in yield terms as we originally provided. Otherwise, we would be faced with an infinite number of possibilities to model, since a constant dividend yield would generate an infinite variety of cash flows for us to model, depending on the exact price path taken by the stock from day one until maturity of the investment. Just before we continue, we note that a $100 initial investment would enable the investor to purchase on day one 2.5 shares of common if the spot price is 40 as indicated here, and that the dividend received annually in cash flow terms would be $0.8 per share, or $2 in total on these 2.5 shares. Now the Excel function rate, for example in this cell here, will be used to derive for each final price scenario the IRR for both the common stock and for the convertible investment, shown in these two columns, G and H, all the way down. As expected, the convertible outperforms when the stock at maturity has fallen, such as here, or even if it has remained unchanged on this row here, or even when it has risen only very slightly, for example to $42, while the pure stock investment outperforms when the stock rises to $44 or anywhere above that. And at very high stock prices, the pure equity investment outperforms the safer convertible by more than 4% annualized, as you can see in the cells we just highlighted. Whereas, we repeat again, at very low stock prices, or even lowish stock prices, it is the convertible which outperforms the stock, and by an even larger margin than 4%, since much of the investor's capital would at that point have been wiped out with the stock investment, with the equity investment. Immediately to the right of this table, we have translated all this information into a graph showing the stock in this blue, the convertible in this lilac, summarizing everything we just discussed. And we pause for a minute to let you reflect on this graph. You might take the view that with the pure equity investment outperforming the convertible under any scenario involving an increase of $2 or more in the stock price over 5 years, the convertible cannot be justified as a competitor to outright shares, on the basis that, in particular, an investor who does not consider such a scenario likely should probably steer away altogether from any securities of this issuer that have any equity component. Perhaps it really all depends on how much the investor can afford to be wrong, and specifically how much she can tolerate the risk of a negative IRR that arises under the pure equity investment in a significant percentage of scenarios, but almost never under the convertible. To give up only a fraction of the annualized IRR in very bullish scenarios, while enjoying a guarantee of a minimum 3% annualized return in even some very bearish scenarios, may seem for many entirely appropriate as a trade-off. We take a moment now to denounce an argument in favor of convertibles that we find particularly silly, namely that they offer allegedly the best of both worlds. Serious finance professionals know better than to suggest that any instrument in the capital markets can, quote unquote, offer the best of both worlds, other than in a very twisted sense of the expression. What they really do offer in any rationally priced and moderately intelligent marketplace is a number of trade-offs that may be especially appealing to certain investors, but rarely to all. This quote-unquote best of both worlds argument seeks to promote convertibles on the basis that in a bull market for shares, convertibles outperform straight debt of the issuer, while in a bear market for shares, convertibles outperform the issuer's common shares. It is usually left unstated that in a bull market for shares, convertibles underperform the issuer's common shares, and that in a bear market for shares, convertibles underperform the issuer's straight debt. And it is almost always left unstated that in a market in which the issuer's common shares rise but only slightly, convertibles may end up underperforming both. The next argument used for the inclusion of convertibles in certain portfolios is that they offer diversification benefits, as their performance does not directly correlate with either that of equities or of bonds. Therefore, adding convertible bonds to a portfolio may reduce aggregate portfolio value without causing any significant reduction in returns or yield. Generally, this appears to have been true for the past 3 decades or so, but with interest rates falling pretty systematically and stock markets rising during this period, it was perhaps inevitable that convertibles would turn out to have offered attractive returns. Whether this proves sustainable going forward remains to be seen. We will discuss convertibles in a portfolio context quite extensively in our modules on portfolio management. So we leave this argument until then and proceed to the next one. In some cases, factors other than purely financial ones may tempt an investor away from stocks and towards the convertible alternative. Imagine an investor who is very bullish on company ABC, but operates under regulations that penalize stock investments versus straight debt or convertible debt. Assume, for example, that debt entails a 1% capital requirement for this investor, while common shares require 10%. Reality is even more hostile to stocks in certain instances, such as under U.S. insurance company capital regulations. This investor expects ABC stock in 5 years to reach 70, so recognizes clearly the superior IRR of 13.47% that he would achieve with a pure equity investment versus 9.6% under the convertible. But assuming the capital regulation treats the convertible as a debt rather than an equity, the investor's return on capital, which we will define here simplistically to mean the ratio of the annualized return over the capital requirement and ignoring funding costs, operating costs, and taxes, the shares produce a return on capital of 134.7% versus for the convertible 960%. Of course, you might argue that it is the capital regulation itself that is to blame for this outcome, partly because it does not differentiate between straight debt and convertible debt, despite the partial equity content of the latter, and partly because the 10 times multiple capital requirement for equities versus debt is not justified, arguably, by actual differences in risk. On both these grounds, you would probably be right, but this would not be the first time irrational regulation brought about perverse incentives and caused investors to sacrifice superior expected returns to enhance their accounting or regulatory metrics. We conclude our analysis of the investor perspective by addressing the critical role played in the convertible bond market by hedge funds, specifically the ones that pursue a strategy known as convertible arbitrage. To do this, we show first how to derive from the price of a convertible bond the implied volatility for the underlying stock. Return to our earlier convertible bond from Chapter 1 and assume it is issued at par as before, but carries this time a 5% coupon instead of our earlier 3%, while all other observable inputs remain the same. We say observable here to remind you that future volatility, especially over a several-year horizon, is the one variable that cannot be observed or determined for certain and involves significant judgment on the investor's part. We can, however, use the pricing model we used earlier in order to extract the single volatility number that would make the fair value of the convertible instrument equal to its issue price, i.e. 100. This worksheet labeled Implied shows us how to do this. We remind you before proceeding that we are ignoring here a large number of model inaccuracies mentioned in Chapter 1, so that the real process for doing this would be significantly more complicated. The higher coupon of 5% appearing in this cell has naturally increased substantially the price of the pure bond component and has brought the total package value to almost $109, as long as we are still using a vol of 30% as our input. So we use GoalSeek to solve for the vol input that brings this total value here in cell E19 to equal exactly 100 by changing the vol input. And after we hit OK, we discover a solution of 16.3%. Now comes the judgment call for the convertible arbitrage fund. Does this level of vol sound about right for the next 5 years? If it sounds low, the convertible is, in a sense, cheap. And if 16.3% sounds high, then the convertible is expensive. The specifics of the arbitrage strategy will be discussed in great detail in an advanced course on hedge fund trading strategies. But its essence consists of buying the convertible if it is deemed cheap, or shorting it if it is deemed expensive, while simultaneously achieving a zero delta for the position by either going short or long, respectively, common shares of ABC in an aggregate amount equal to the convertible's delta. Subject to a number of risks not materializing, such as a rapid change in the issuer's credit spread, or a significant change in the company's dividend policy, or a material change in the tax law, the arbitrageur makes money if the realized volatility turns out to be consistent with his expectation and different from the level implied by the price of the convertible. To spell it out specifically, the position long convertible / short common stock makes money if realized volatility proves to be higher than implied, whereas the position short convertible long stock makes money if realized volatility proves to be lower than implied. This completes our discussion of the principal investor motivations for purchasing convertibles. The issuer's interest in convertibles spans a wider range of considerations, many of which involve tax, accounting, regulatory, or legal considerations, some of which are discussed in Chapter 5, rather than strictly financial ones. A full understanding of these matters, therefore, awaits that chapter. From the strictly financial perspective, the issuer is drawn to the convertible bond by the coupon savings versus straight debt and the related preservation of cash that the instrument makes possible, both in the form of lower periodic payments of interest, as well as the significant likelihood that the instrument will redeem via the delivery of stock certificates instead of cash. It would be very misleading, however, to say that the convertible is cheaper than straight debt in all cases. Its cash outflows are lower than straight debt in all cases. But when conversion takes place, the existing shareholders are being diluted by the newcomers and may find themselves delivering share certificates worth far more, in some cases, than the face value of the debt being turned in for conversion. In a sense, this is a so-called rich man's problem, i.e., a problem that becomes worse and worse precisely when the company is doing better and better and seeing its share price soar. So perhaps it is a problem well worth accepting in exchange for the reduced cash outflows. A second attraction is that the likely correlation between credit spread and equity volatility, mentioned previously, inures to the benefit of the issuer. Precisely when credit spreads are high, and therefore straight debt is particularly expensive, equity volatility is likely to be high as well, making the embedded equity option more valuable and hence pulling the convertible's coupon further down in relative terms and sometimes even in absolute terms. To illustrate this effect, let us assume a very straightforward relationship between credit spreads and equity volatility, specifically that the annualized vol expressed in percentage is exactly 10 times the credit spread, also expressed in percentage. Illustratively, when the credit spread is 200 basis points or 2%, that would mean the stock's vol is 20% annualized. And when the spread is 400 basis points, vol would rise to 40%, consistent with the positive correlation assumption. We can proceed to calculate for each level of ABC's credit spread, and by extension equity vol, the coupon a convertible would need to offer if it is to be worth exactly par, just like a straight bond. In other words, we ignore here any incentive needed in reality to entice investors into the convertible market. We will provide one example in detail and then summarize the overall results in a table. Taking first the case where the credit spread is 400 basis points, or 4%, and thus leading to a coupon all-in of 9% on the straight debt. We use this worksheet here labeled coupon to calculate the fair size of the coupon on the convertible. This worksheet being essentially identical to our earlier pricing worksheets, except for the fact that in this cell C12 for volatility, we have actually programmed the relationship, the 10-to-1 relationship between vol and credit spreads. Now, seeing that the convertible is coming out to 99.80, we use goal seek to make it equal exactly 100 in value by allowing the coupon to change, and it's obviously going to rise a little bit. And here we go, discovering a solution of 3.05% corresponding to the credit spread of 400 basis points. Make a mental note of that, but you will see it in just a moment written on a slide as well. Now, if we assume the credit spread itself rises by an extra 100 basis points, so it becomes 5%. This, of course, pushes the vol up to 50%, given the formula. And now we need to solve again for a coupon, because as you can see, the convertible has risen in value to 102.70. So if we want to issue it at 100 fair value, we would reduce the coupon down to 234. Again, make a note of this number in your head, 234, previously 3.05, until the next slide. The table appearing now plots the coupon on the convertible corresponding to each credit spread appearing in the left column, shown, to which corresponds a unique equity vol that will appear in the middle column. So for a 100 basis point credit spread, the coupon turns out to be 5.02%. For a 200 basis point credit spread, the coupon turns out to drop to 4.43. And this pattern of rising credit spreads but diminishing coupons for this particular set of circumstances actually continues all the way down the end of this table, reaching at 700 basis point credit spread, so perhaps a single B or triple C rated company, a coupon as low as 0.98%. The point by now should be clear, but we emphasize, however, that it will not always be the case that a wider credit spread will necessarily entail a lower absolute coupon on the convertible. What is certain is that if the wider credit spread is, as would seem entirely logical, accompanied by a higher equity volatility, then the higher funding cost for the issuer will be offset to some degree or other by the greater value the issuer would obtain in the convertible market by selling calls on himself. This principle is sometimes summarized by saying that the convertible is the only major instrument in the capital markets that permits a borrower to monetize an increase in his risk, whether actual or perceived. This completes the second chapter as well as part 1 of this module.